Good morning. My name is David Malik, and I'm here with my partner, Stuart Bollifer. We're going to be presenting a webinar today on the new income splitting rules. Aaron & Burles is a 155 lawyer downtown Toronto law firm. Our tax group has 19 lawyers and 8 clerks. We have a large estate planning and reorganization practice, including 5 clerks doing primarily reorganization work. You'll see beside the slides there's a Q&A where you can put questions in. If we have time, we'll answer some of the questions. We're going to do a detailed analysis of the rules, and then we're going to go through 13 different examples. We're focusing mainly on corporations, and we'll talk briefly about partnerships and trusts, but mainly we're focusing on corporations, although the rules also apply to partnerships and trusts. What happened? As you know, prior to 2018, private companies could generally income split with spouses, adult children, and other adult relatives, subject to some limitations. Income splitting is basically shifting income from a high-rate taxpayer to a lower-rate family member, and it's often achieved using an estate freeze. The founder takes his or her shares in a corporation and exchanges them for fixed-value preferred shares, and a new trust or family members subscribe for common shares for a nominal sum. And this is what it generally looks like. You have the founder owning the fixed value preferred shares and the family trust owning the non-voting common, and the question then becomes who are the beneficiaries of the family trust, often the founder, spouse, children. So dividends can be paid up to the trust and out to the family members, and thereby transferring income from the founder to hopefully lower paying taxpayers. The tax on split income came in many years ago, and really when it came in, it only applied to tax dividends paid to children under 18 years of age. And I'm going to refer to the tax on split income as TOSI. Sometimes you had to pay a dividend on the preferred shares depending on the nature of the business, but generally speaking, the overall rate of tax in the household was reduced. July 2017 were the rules proposed by Morneau, which were extremely complicated and comprehensive. There were 12 pages of legislation to accomplish reduced income splitting, and much broader than the rules as they are now. Because of all the complaining, perhaps, because of all the submissions, our firm was very active in not only writing and speaking, but also talking to politicians. We made submissions to the Department of Finance. We had articles published in the newspaper, and I think those efforts by us actually helped make these changes. And on December 13, 2017, new draft legislation was tabled, narrowing the scope of the income that's caught and providing more specific rules and exceptions. These new rules expand the TOSI rules to potentially apply to spouses, minor and adult children, parents, and siblings. And they're defined as specified individuals. If you're caught by these rules, the person caught by the rules is taxed at the top rate. These rules came in force on January 1st, 2018, although the legislation has not as yet been passed by Parliament. And I think there might be some minor tweaking before it actually goes through the House and is passed. The December 13th amendments deleted aunts, uncles, nephews, and nieces from the TOSI rules. Therefore, you have an opportunity to income split with adult nephews, nieces, aunts, and uncles. And one important change is, originally when the rules came out, if you were caught by the TOSI rules and had to pay tax on dividends, say, any income earned from those funds were also going to be taxed at the top rate. That's really referred to as TOSI on TOSI income. Those rules were eliminated. So there's no longer a necessity, if you are taxed under these rules, there's no longer a necessity to track how much income you earn on those funds. So how do you get caught? The person who gets caught is a specified individual, and that person must be resident in Canada at the end of the year or immediately before their death. And if that person's under 18, they have to have a parent resident in Canada at any time in the year. And in order to get caught by these rules, the specified individual must be related to a source individual. We'll call that person the founder of the business. And somehow you have to be connected to a related business. And all the red items on these slides are defined terms. And we're going to use those on the slides until we get to the examples at the end. The rules don't apply to non-residents. However, of course, they would be subject to withholding tax on any dividends paid out of a corporation. So the December 13 amendments changed the structure of the TOSI rules from what was proposed in July. So while the group or categories of individuals subject to the rules has been broadened considerably, there's now a list of amounts that are excluded. They're referred to as excluded amounts from the TOSI rules. So things like gains on the disposition of shares of a qualified small business corporation. This is where you're getting the capital gains exemption. So if the shares are shares of a qualified small business corporation, any gain on those shares is excluded unless there's a non-arm's length sale and the gain is being reported by a minor. Dividends and capital gains on excluded shares realized by persons 24 years of age or more before the year are not caught. So that's when you're 25 years of age in the year you're being taxed. And if the business is an excluded business, the TOSI rules won't apply. So we have to now go and look at what do the defined terms mean, the excluded amounts, excluded shares, and excluded business. The rules have three classes of specified individuals, the people who might be caught by these rules, and the tests are different depending upon your age. So individuals under 18 are one class. They were already caught by the previous TOSI rules. Individuals 18 to 24 are the second class, and individuals 25 or older are the third class. The reason why they've brought in this new category of individuals 18 to 24 is when the government studied income splitting, they discovered that probably the biggest increase in income splitting over the last 5 or 6 years has been for those children who are 18 to 24. And that's why they put this category in.
And I'm just going to interject occasionally. We'll try and be a bit interactive. On the drafting is interesting because they don't actually talk as simply as saying you got to be 25 or older. They say you have to turn 24 in the preceding year. And I think the reason they drafted it that way was that you could in theory have somebody who's 24 in the year who's going to turn 25 in the year, and he could get a dividend in the year when he was still 24 as long as he turns 25 in that year. Or if he died before turning 25, but he was 24 in the preceding year, he would still be okay. So I think the drafting picks up those interval kind of situations where the person hasn't quite turned 25 in the year.
So related business, so in order to get caught by these rules, you have to have a related business. And for individuals 18 or over, the TOSI rules only apply if an amount, a dividend, a capital gain, or interest, is derived directly or indirectly from a related business. And to be a related business, you first have to have a source individual. So think of the source individual as the founder of the business, but it's someone who's related to the specified individual. And so the source individual has to be resident in Canada in the year and has to be related to the source individual. Related is a defined term and includes your mother, father, your spouse, your son, daughter, brother, and sister, and any of the above as a result of marriage, so daughter-in-laws and son-in-laws. But this is where before they had included niece and nephews and aunts and uncles, and those are now excluded. And their technical notes state that the income splitting arrangements are seeking to reduce tax by decreasing the amount of income derived from a business. And I think this is important that the notes are talking about a business where a higher individual is transferring income to a lower income earning individual. So the source individual must be sufficiently connected to the business for the specified individual to be caught by the TOSI rules. So you have to look at what the source individual, the founder, what the connection is to the business. And this is provided in the definition of related business. So the business is a related business if the source individual carries on the business or is actively engaged in the business carried on by a partnership, corporation, or trust. So if the founder of the business is actively engaged in the business, then it's a related business. The second one is if the business is operated by a partnership and the source individual has an interest in the partnership. So unlike a corporation, having just an interest in a corporation isn't going to count until we get to C, but if you have any interest in a partnership, directly or indirectly, If the source individual has an interest in a partnership, you're caught. So if the founder has any interest in the partnership and tries to income split with a spouse or a child, then you have to look to see whether the income's TOSI, but you're generally caught by the rules. If it's a corporation, the source individual has to own at least 10% of the total fair market value of the corporation or some derivative instrument that may represent that same value. So those are the three tests for related business. So what if there's no business? Will the TOSI rules apply? So what if a founder buys $5 million of preferred shares in a company and pays a prescribed rate dividend on those preferred shares? Common shares are held for spouse and adult children, and then the corporation buys a rental property and hires someone to manage that property, an outside third party, so there's no employees in the company. Is there a related business? And I don't think the rules are entirely clear on this. It would appear that the finance department only wanted to catch situations where there was a business carried on. And we've had some discussions with finance. We're hoping they clarify these rules. But you would think that in this situation that you're potentially not caught by the TOSI rules. I don't think that's black and white right now. And I think from a practitioner's point of view, we would like certainty on this, because we don't want to put this structure in place and then find out down the road in 3 or 4 years that they intended to catch it. And in discussions with finance, they're not entirely clear on what they intended. And I'm hoping there'll be some clarification from that. Now, in the example I gave you, what if the monies to buy the rental property didn't come from a tax-paid money that the founder put in, but came from an active business? I think then, because of the extended definitions in the legislation, that's probably caught by the TOSI rules. So when do the TOSI rules apply? So where a specified individual receives split income, the TOSI rules will apply. Where the specified individual is under 25 years of age, or the amount is received by a specified individual and it's unreasonable in relation to his or her contributions to the entity. So it's a test on whether or not what the person's receiving is reasonable based on their contribution. And you'll notice the second test, you have to be 25. And we're going to get into that in a little more detail later on in the slides. And if you're caught by the TOSI rules, the related individual, the source person, is jointly and severally liable for the tax if the person who is receiving the TOSI income is under 25 years of age. So what does split income include? It includes taxable dividends from corporations other than shares listed on a designated stock exchange or shares of a mutual fund corporation. It also includes income derived directly or indirectly from a related business owned by a partnership or a trust. And there's an extended definition here where they say amount derived directly or indirectly from a business. It includes an amount that's derived from the provision of property or services to that business. So if you have an entity providing property or services to the business, that's also going to be caught by the related business and by the split income definition. And it also catches amounts that arise in connection with the disposition of an interest in the business. So just a bit of an extended definition. It also includes income derived directly or indirectly by a partnership or a trust from the rental of property if a related person is actively engaged on a regular basis in the activities of the partnership or the trust or owns an interest in the partnership or the trust. It catches income if other amounts received from that entity would be split income. So for example, if a dividend on shares would be caught by the split income rules, then a loan to that company where interest is paid might also be caught by the TOSI rules. And it includes capital gains realized on properties, again, the income from which would be split income. So the definitions are still pretty broad. The rules are much simpler than they were when they came out in July 2017, but they're still pretty broad in trying to catch all different types of income. So once you decide, if you decide it's split income, and it might not be split income, but once you're in split income, you have to decide if it's an excluded amount. And that's the main definition that's going to get you out of the TOSI rules. So some of these changes are very good, and they resulted from people writing in and indicating problems with the rules. And so one of it is dealing with death and breakdown of a marriage. So if you're under 24 before the year, so if you're 25 in the year, property acquired as a result of the death of a parent is excluded, or of a non-parent if the individual is enrolled in a post-secondary program or is eligible for the disability tax credit. Not a good planning opportunity because somebody has to die, but they've done a pretty good job in dealing with death and marriage breakdown. If you acquired the asset as a result of a marriage or common law relationship breakdown, you're not caught by the TOSI rules. Taxable capital gain arising as a result of the death of an individual isn't caught. So one of the things we were concerned about when the July proposals came out is, your child is caught by the TOSI rules and dies. And when they die, they have a disposition of all their assets at fair market value. And if you were caught by TOSI on those, you would be taxed at the top rate. So they've taken away, or they've excluded capital gain arising on the death of specified individuals who you'd be looking at. And then they've also eliminated a capital gain arising on the disposition of a qualified farm or fishing property or qualified small business corporation shares. These are the shares eligible for the capital gains exemption. So this is basically if you own shares of a qualified small business corporation, any gain on those shares, whether it's eligible for the exemption or whether you're over that limit, is going to be not caught by the TOSI rules. The only caveat to that is if the specified individual is under 18 and there's been a disposition of shares to trigger the gain, it's got to be an arm's length one. And this is an existing rule in the Act right now. They're just clarifying that that's still caught. So it's going to be very important to make sure, if you want to take advantage of this, that your company actually qualifies for the small business, that's actually qualified small business corporation shares. So then we look at, continue on excluded amount. If you're 18 years or older, and the amount is not derived from a related business, or is derived from an excluded business. So this goes to the point, if you're 18 years of age or older, and there's no business, it should be excluded. And then if you're between 18 and 24, and this is where you'd be making a loan, and the amount is a safe harbor capital return, then you're going to be okay. And that is basically a two-folded test here, and this is probably not going to arise very often. But you're going to be looking at the highest prescribed rate in the year. That's one side of it. And the second is it a reasonable return on arm's length capital having only regard to the capital contribution of the individual? So I don't think loans from 18 and 24-year-olds, between 18 and 24 happens very often, but they loosen these rules so you can pay a little bit higher return. And the arm's length capital you're putting in here can't be borrowed or gifted from the individual who has a related business. So you can't get a gift from the founder and then make the loan and get this rate of return. But it can be from an inheritance. And the last one, if you're 24 or older, so you have to be 25, income or capital gain from excluded shares or a reasonable return are also excluded. So these only apply if you're 25 or older, and we're going to get into a little more detail in a second. Stuart has something to say.
I don't think we have a slide on this specifically, but just going back to Dave's point about the existing rules, and if you're under 18 and you realize a capital gain in a non-arm's length transaction, you're subject to the TOSI rules. And just a reminder that not only are you subject to the TOSI rules, but twice the amount is included into income, so you don't really get capital gain treatment. And if you remember back in July, the July rules had that special penal provision apply to any transaction, even between adults, where, say, two brothers are in a business and one brother sells his shares to the other brother because they were related. Under the old rules, that would have been subject to TOSI and not treated as capital gains. It would have been twice the taxable capital gain would have been included into income. There were a lot of representations made, including from ourselves, and fortunately that rule now is completely gone, and it's only a concern if the person is under 18.
And just one other point I think I missed, I'm just going to go back here, with respect to the capital gain from the qualified small business corporation shares. That also works with respect to allocating the capital gain from a trust to a beneficiary. So In a lot of these rules, owning through a trust doesn't work, but with respect to shares of a qualified small business corporation and the capital gain arising on those, you can hold those through a trust, which is a good change. So if we have an excluded business, then the TOSI rules won't apply, and to have the excluded business, the individual has to be 18 or older, and you have an excluded business for all amounts other than capital gains. So this would be for dividends, for example, or partnership distributions or trust distributions where a trust is carrying on a business. The individual must be actively engaged on a regular, continuous, and substantial basis in the year or in 5 previous years. So that's not any of the 5 previous years, but any 5 years. So if the business started in 1980, and the founder worked 5 full years in the business full time and then retired in 1980, that founder is still fine getting dividends right now. For capital gains, so in order for you to have an excluded business with capital gains, you have to be working actively engaged on a regular and continuous basis, not just in the year, but it's got to be in 5 previous years. So if the business is sold after 3 years, then you can't rely on the excluded business definition because you weren't involved in the business for 5 years. And so it's really important on this test that it's what does actively engaged on a regular, continuous, and substantial basis mean? Like, who knows what that exactly means? But what they've done is they put a deeming rule in, and the deeming rule is you're deemed to be actively engaged if you worked an average of 20 hours per week throughout the portion of the year that the business operates. So the reason they put the portion of the year the business operates is it deals with seasonal businesses. So if you're working 20 hours a week for the year, that's I guess 1,000 hours, then you're deemed to be actively engaged on a regular and continuous basis. But if you're not in that situation, let's say you have a business where it only requires 10 hours of work a week, so you don't get into the deeming provision. So you're not deemed to be there. But then you go back and say, okay, you work 10 hours a week, and is that actively engaged on a regular, continuous, and substantial basis? One of the examples Stuart's going to discuss goes into this, and it's going to really be based on the facts. And I think it's going to be, a good question each time. Are you actively engaged or aren't you? So Stuart will talk a little bit about that later. One issue, though, is how do you prove that you work 20 hours per week? So not too many businesses have time cards that you push when you come in, but I'm thinking maybe you should get one. And if let's say you have a founder now who worked full-time for 5 years from, like the one I said, 1980 to 1985, and is now getting monies from the business that his or her children run, how is that person supposed to prove that they work 20 hours a week between 1980 and 1985? So I think record keeping is going to be important if you really want to be relying on this exemption for excluded business. I think you're going to really want to somehow track when the person works, when they come in, when they go home. So if you're 24 or older before the year, again, that means you're 25, then you might be able to rely on the excluded shares exemption. So shares are excluded shares if less than 90% of the business income is from services, and we're going to get into the whole question of what is business income and what isn't, and I'll come back to that in a second. In this case, the corporation can't be a professional corporation. Finance doesn't like doctors and lawyers and dentists, and probably this is why these rules came out in any event, just to catch this.
Apparently engineers are okay, though.
Yeah, engineers aren't in here because it's a defined term. But if you're an accountant, dentist, lawyer, medical doctor, veterinarian, or chiropractor, then you can't rely on the excluded share rules. Doctors before could have spouses and kids owning shares. Lawyers couldn't. The only person who can own shares of a lawyer professional corporation is a lawyer. So if someone's spouse is a lawyer, they could be a shareholder. So to be within the excluded share exception, the individual, so this is like the specified individual, has to own 10% or more of the votes and value of the corporation. So let's say you own 10.1%. You have to be wary of whether a minority discount might kick in to say whether or not you have 10% of the value. And the trick here is the shares that are excluded are the shares the individual owns. So this can't be held through a trust to rely on this exemption, and you must own the shares. So if the specified individual owned 15% of the shares directly and 20% through a family trust, only the 15% they own directly can be eligible for this. So you got to do some balancing here on whether it's worth it to have someone own shares directly in your business versus holding in a trust where you can avoid a deemed disposition if the specified individual dies. And also, it's hard to move to this situation in an existing business. So if the founder has a business worth $5 million and wants to do a freeze, and they'll take back $5 million of preferred shares, then the adult children or spouse can own more than 10%, buy some shares, but they also have to own 10% of the value. So you'd have to have a disposition of some of those preferred shares. So maybe you can do it because you have the capital gains exemption, but it's going to be hard to fall into this on a going forward basis. It might work fine for structures that are already in place, where a family trust owns a bunch of shares, and maybe they can be distributed out. Also here, for this to work, income of the corporation can't be derived directly or indirectly from another related business. So what they're aiming at here is preventing a service business being split into two businesses. And so, this is just a dumb example, but let's say you were a business of painting. You could sell the paint to the customer, and then you could sell the service of putting the paint on their walls. Those could be in two different entities. That's what they're sort of trying to prevent. I don't know why it is that they've decided that they don't want to allow service businesses to benefit from this. Maybe it's because most of the businesses in Canada are service businesses, but I guess a manufacturing business is fine. But then you get into this question. I have a business of a service business, and I also own a rental property. And the rental property generates 15% of the income of the company, and the business generates 85%. Is it possible that I qualify because the rental isn't a service? And I think that's going to be still up in the air on answering that question. We really have to figure out whether a passive asset could be a business asset. If the passive asset is a business asset, then under this test it would be fine. But if the passive asset, owning a passive asset is a business, then you're going to be caught by the TOSI rules. So I think probably the result's going to be that a passive asset is not a business, and therefore to be here, 90% of the business income has to be from services. Having a little rental property probably wouldn't help you. But again, not clear yet. For 2018 only, the 10% votes in value can be met either before the relevant time, the time of a sale, or at the end of 2018. So that's going to allow you to remove shares from a family trust to qualify for this exception. A Holdco Opco structure is problematic. If the Holdco does nothing and just owns shares of the Opco and receives dividends from the Opco, you're probably not going to qualify owning shares in the Opco, and Stuart's going to take you through an example on that later. And in this situation, as I said, shares cannot be owned by a trust. So the last thing is reasonable return. And this is interesting because if you're 24 years or older before the year, so 25 in the year, you're otherwise caught by these rules. So you're caught by the TOSI rules. You're not working more than 20 hours a week. The shares aren't excluded shares. Can you get out of it in some other way? So you look to whether or not the person's getting a reasonable return, and you're looking at these factors. So the amount's going to be reasonable in regard to the work performed, the property contributed directly or indirectly, the risks assumed, how much has already been paid to that individual, either directly or indirectly, and other factors. In the previous rules, there was an arm's length standard here, but now there isn't. So why is it that the government doesn't want to look at someone under 25 and what they did in the business? And why are they not taking that into account? I don't know why, but I guess if you're making contributions to the business and you're under 25 and you're not otherwise out of the rules, I guess you should be taking a reasonable salary.
And one of the interesting changes they've made is that they've said that the contribution is supposed to be measured against the contribution made by the source individual. That's the person who's active in the related business. And I guess that could work for you if the source individual isn't doing a whole lot. or it could work against you if the source individual is the visionary and really responsible for everything. I suppose it gives you an argument, some cases in your favor, some cases against you. But I think the point that Finance was trying to make in CRA and the guidance that it released along with the finance draft legislation is that they're not going to look too closely at judging you if you can make a reasonable argument. But again, it does point to the fact that it is interpretive and it's not clear.
So before we get to the examples, just a couple of additional rules. If an individual is 18 or older and inherits property, is not TOSI to the extent that an amount, had it been received by the deceased person, would have been a reasonable return. And income on the inherited property would not have been TOSI to the deceased because it was either an excluded amount or an excluded business to the deceased. And also in a death situation, if the deceased had to be 24 or older before the year to qualify, the individual will be deemed to be 24 before the year if the deceased was. So not a very important change. But this last point is probably, considering I'm 63, it's a very good point, which is the TOSI isn't going to apply if the spouse of the specified individual attained the age of 64 before the year. So if the founder of the business turned 64 before the year or was 65 in the year, then you can income split all you want with your spouse. And that's also if they died before the year. So basically, the reason they brought this in is, the ability to split pensions and stuff was in the Act already. A lot of complaining about how unfair it was to not allow businessmen to do the same thing. And basically, it gives you a get-out-of-jail-free card if the source individual is 65. If the specified individual, so if the source individual, the founder, is 60 and the spouse is 65, it doesn't work. It's only if the founder is 65. So I'm going to go through a few simple examples, and then Stuart's going to do the more complicated ones. So here we have family trust ownership. So here we have a founder, did a freeze, has fixed value voting preferred shares. The family trust is in place. The beneficiaries are the founder, the spouse, children, including minor children. So how do the rules apply here? So provided shares are shares of a qualified small business corporation, the capital gains exemption would be available to family members. If you're under 18, it must be pursuant to an arm's length sale. So this is where we didn't get rid of the trust, we kept it in place, and we're going to be selling shares out of the trust. If the company qualifies for the exemption, then there's going to be no TOSI. How about dividends? So if dividends are paid, so this is where dividends are paid from the Opco up to the family trust. And it should have said common shares. The family trust would own common shares here. So if there's dividends paid up, and if Opco carried on a business, unless the beneficiary is 25 or older, and the dividend is reasonable in relation to that person's contribution, or the beneficiary is 18 or older and actively engaged in the business, those are the two times when a dividend won't be TOSI. Otherwise, it's TOSI. We can't rely on the excluded share exception because the trust owns the shares, not the individual. So how about if we have this situation? Founder has 50 common shares and the spouse owns 50 common shares. So we're going to assume the business is a related business, so there's a business carried on in that company. So there's no TOSI here if the founder is 65, if the spouse is 25 or older, and the return of the spouse is reasonable in relation to his or her contribution, if the spouse worked more than 20 hours per week in the year, or each of any of the 5 previous years, or if they're making a substantial, if they're working substantially in the business, they're also not caught. And it can't be a professional corporation, and less than 90% of the income is from services, and the spouse owns 10% or more votes in value. So that's the excluded shares. So here the spouse owns shares directly. So if this isn't a professional corporation, and let's say the business makes widgets, so it's not a service business, and the spouse owns more than 10% of votes in value, which they do here, then you're going to be outside of the TOSI rules. So the same fact situation, only this time with a child owning 50 common shares. Again, we're assuming the business is a related business. There's no TOSI if the child's 25 or older, and the payment of the dividend is reasonable in relation to the contribution of the child. I keep referring to the 20 hours per week because I'm focusing on the deeming provision, but you could also be okay if they're doing substantial work in the business. So the second test, again, is child is 18 or older and worked more than 20 hours per week in this year or in 5 previous years. And again, the same test on owning more than 10% of votes in value. You have to be 25 or older. It's not a professional corporation, and less than 90% of the income is from services. And the child owned 10% more of votes in value, which the child does here.
And then, Dave, I guess if the child sold the shares, they'd have to be active for 5 years, right? Before the capital gain would be exempt from TOSI.
Right, right. So this is your big opportunity with your nephews and your nieces. So here the founder owns 50 common shares, and the nephew owns 50 common shares. So what happens? I'm assuming it's not a related business because there's no TOSI if the nephew is 18 or older, because there's no source individual, because the nephew is not related to the founder. If it's a partnership or a trust, the way the rules are drafted, so again, we're focusing mainly on corporations. Corporations, anybody's potentially caught by the TOSI rules, you have to get out. If it's a partnership or a trust, then the nephew doesn't have to be 18. So, but what if the nephew's father, so the brother of the founder, works full-time in the business? What happens? Then there is a related business because the father's working full-time in the business. That's one of the tests. If you're working full-time in the business, then you're potentially a source individual. And in that case, the nephew then would be related to a source individual and would be caught by the rules and have to rely on some of the other exceptions. So just a simple loan by the child. So here the child's making a loan. Maybe the child won the lottery or something, got an inheritance from granddad, or worked in the summer and made some money and is loaning to the Opco. So here we're assuming the business is related and there's no TOSI on the interest. If the child's 18 to 24 and the interest is not more than the highest prescribed rate in the year, currently 1%, or does not exceed a reasonable return on arm's length capital. And if the child's 25 or older, then you go into the reasonable return test. What else is the child doing in the business, if anything, and what would be an appropriate return? I think we're over to the more complicated examples for my partner Stuart.
I'm just going to see if I can get the clicker to work right. Okay, good. So Dave and I talked about this. I don't know if Dave mentioned it, but first of all, we'd like to give a shout out to our moms. Dave's mom is 96 and my mom is 93. And they said they'd tune in and listen. So, Mom, I just want to tell you that I took your advice and I got my hair cut so I'd look good for the webinar. And hopefully that comes through.
And also, David speaking, Mom, we're not income splitting.
Yeah, we talked about it. We're not doing it. So I'm going to take you through some examples. And really, the points I'm bringing out have already been discussed by Dave, but there's been a lot of rules Dave's gone through. So we're hoping to try and reinforce these rules and bring out some nuances in each of the examples. And Dave will jump in if he has a point he wants to make as well. So this is the first example where we've done a typical estate freeze. Maybe not quite so typical because here we have two siblings as opposed to parents. So sibling one, sibling two. And typically when we do a freeze, we get the freezor to exchange their shares for non-voting free shares, because those are the ones that typically get redeemed, and we give a class of voting shares that have no other value at the same time, so that if you do a wasting freeze and redeem out those preferred shares over time, the siblings can still, the freezor can still have control through the ownership of the special voting shares. And then we've got a family trust for the benefit of the family of sibling one, and family trust two, benefit of sibling two. And in this example, we've got a real estate company that owns one large residential apartment building. Sibling 1 does about 20 hours a week in it, which is probably high, but I've made that fact. And sibling 2 does very little. So we say, well, first of all, the first question, and I'm going to go back to the slide, the picture, but first question is there a related business? So there has to be a source individual who's involved, or the corporation has to be involved in carrying on a business. Now, for tax purposes, there is a presumption that a corporation carries on a business, but it is a rebuttable presumption, so that if the only income of the company is from property, and there isn't enough sort of busyness or activity to morph that into a business, then I think you can argue that it's not a business. If, for example, you just had portfolio investments in a company that aren't tied in any way to another business, and we'll talk about that later, then again, it should not be a related business. So here it's a question of fact. If you had, several residential apartment buildings, you might be more likely to have a business. Certainly if it was a hotel, even though the hotel effectively just earns income from renting out the rooms, because of the level of services that you provide in a hotel setting, it's probably a business. But a pure real estate company, you've got a decent argument that it's not even a related business. And if that's the case, then these TOSI rules won't apply to sibling 1, sibling 2. If you paid dividends in the family trust, as long as the children were 18 years of age or older, you wouldn't have a problem. You would have to worry about Section 74.4, which is the corporate penal attribution rule. But so that's an initial decision we'll have to make, and it's not going to be that simple, and some of the examples will draw that out. So let's assume it is a related business. Maybe you got lots of services being provided or lots of properties. The next thing is we want to redeem those preferred shares out from sibling 1 and sibling 2. And when we redeem the shares, we're going to have a deemed dividend. And so that deemed dividend could be subject to TOSI if we can't find an exception. In the case of sibling 1, because they're active 20 hours in the business, it should be an excluded business to sibling 1, and the deemed dividend should not be a problem. But sibling 2 can't rely on that exception because sibling 2 is not active in the business, so the excluded business exception doesn't apply. We have to find another exception. And that one is the excluded share provision. If these shares are excluded shares, then we can redeem the shares to sibling 2, and we won't have a problem. Now remember, to be an excluded share, you have to have shares that have 10% of the votes and 10% of the value. So when you initially do the freeze, you're not probably going to have a problem with the value, unless you had like 11 siblings freezing. And I have one where I'm doing this with 4, so I have to be a little more careful. But here they got 50% of the value, so that's not a problem. But the way I've got this structured, I got a problem because the non-voting, the free shares are non-voting, so they don't meet the 10% vote tests. Now in this case, I could do a reorg sometime this year, and as long as I gave those free shares votes by the end of the year, they're deemed to be okay throughout the full year. So if you've got situations like this, you got till the end of the year if you've been redeeming shares, triggering dividends to get the shares on side. I think the value component will be trickier though, because as you start redeeming, eventually you're going to get down below 10%. And as Dave mentioned, it's only the dividends on these free shares that are going to be protected, not if you paid dividends on the common shares to the trust, and the trust paid, trust number 2 paid distributions to sibling 2, even though sibling 2 has the preferred shares, that might be okay. The dividends from the trust that are distributed from the trust are not. So it is a limited exception. And I'm not sure how you deal with situations as you start redeeming down and they own less than 10%. And then, as I'd mentioned, dividends paid to the trust of sibling 1 and distributed to sibling 1 are okay because it's a reasonable return of the sibling. If they're allocated to sibling 1's children, probably will be TOSI unless the children are full-time. So that's an example of the freeze. This is one that I think has David and I scratching our head a bit, because I'm not sure why this, I mean, technically, this seems to be the result. I'm not sure why it is. So here we have a common Holdco-Opco structure, where Opco is the one carrying on the business and pays dividends to Holdco. Holdco invests some of the dividends, and from time to time, it pays dividends to sibling 1 and sibling 2. Sibling 1 is active in the Opco business. Sibling 2 is not. So you have a related business. Both sibling 1 and sibling 2 are specified persons because the other sibling is a source individual. And now you say, well, what happens if we pay dividends to sibling 1? Well, sibling 1 is active in the business of Opco, but it's not active in the business of Holdco. First thing I got worried about is, does that mean the Holdco dividends aren't excluded under the excluded business provision for sibling 1? But it is okay, because if you look at the second bullet, dividends paid on Holdco shares to sibling 1 should be excluded because of the expanded language. It's derived directly or indirectly from an excluded business. So because the dividends being paid from Opco come from after-tax earnings of Opco's business, and they're paid up to Holdco, then when Holdco pays a dividend to sibling 1, sibling 1 should be fine, and he can rely on the excluded business exception. But that's not going to help sibling 2, because sibling 2 is not active in the business. So then the next out is, just returning to the picture there, sibling 2 has, let's say the shares are 50-50. I should have put that in. Are those shares excluded shares to sibling 2? Well, sibling 2, if they're 50% of the common, they would have the votes test, right, 50%. They would have the value test, 50%. But there's another provision in the excluded share definition that Dave mentioned, and that's the first bullet, the first indented bullet on the screen. To be an excluded share, all or substantially all of the income of Holdco is not derived directly or indirectly from a related business of sibling 2. So there's an expansive definition in the next bullet. An amount's considered to be derived directly or indirectly if it arises in connection with the ownership or disposition of an interest in the person carrying on the business. So here you've got Holdco. It's got an interest in Opco. It owns the shares of Opco. So Holdco is getting dividend income from Opco, and that means that the dividend income arises in connection with that ownership. So that dividend income that Holdco gets is considered to be derived from a related business. And that means that you have fallen outside the definition of excluded share. I don't understand why that's the case. It means that any time you roll into a Holdco structure, you're going to end up running outside of this excluded share rule. And we're writing into finance to see, did they really mean to do that? Because it seems it seems pretty odd. Now let's just go back for a second, because this will be relevant. If Holdco takes those dividends and earns investment income, and then say 5 years later it pays a big dividend to sibling 2 out of that investment income, could you argue that, well, Holdco doesn't carry on a business of investing. It's just putting it in the public markets. There's no business there. So maybe there's no related business with respect to that income when you pay the dividend to sibling 2. Should sibling 2 be okay? And I think the answer to that is no, because when it comes to determining whether that dividend is caught, there's a similar rule that says that if the dividend income earned by Holdco, if the investment income earned by Holdco comes basically from the dividends of Opco, then that probably is considered a related business because it's derived from the business income of Opco. So even though Holdco doesn't carry on a business in relation to its investments, it's still a nexus with the underlying Opco business. And I don't think you can get out of the income splitting rules with respect to the Holdco investment income. So here's an example which brings out a couple changes from the July legislation where you've got a sale of shares and parent's going to sell his shares to the child for a promissory note, realize a capital gain, and then the child will take the shares of Opco, transfer them to a Holdco for debt, and over time Opco can pay Holdco dividends, and Holdco can repay the debt to the child, and the child can repay the debt to the parent. Now this only works if the parent doesn't realize the capital gain exemption, but if you look first at the parent, will the parent have a gain on the sale of the Opco shares that's subject to split income? Well, first of all, is there even a related business? Well, if parent's the only one of his family active in the business, there's no related business and there's no TOSI concern. But if, say, the child was active in the business, then it might parent might be a specified individual, so you have to find an exception. And the exception here would be probably he's active, it's an excluded business as long as he was active for 5 years or more. And Dave brought out the point was, what if it's a fairly new company and he's only been active in the business for 3 years? Then the excluded business exception wouldn't apply to the capital gain. It would apply to the dividend received because you only have to be active in the year, but for gains you have to be active in any 5 previous years. So if it was a new business, and then you'd have to find another exception, and in this case it probably would be an excluded share as long as it wasn't a service business of Opco. Parent has more than 10% votes in value, so they're probably excluded share. And the other out is, would the shares have qualified for the capital gain exemption? So this is interesting. So even if the share would have qualified for the capital gain exemption, but the parent chose not to claim it, that would still get him out of TOSI or her out of TOSI. You don't have to claim the capital gains exemption to fall within the TOSI exception. Or let's say the gain was significant, so that part of the gain was exempt from because of the exemption and the balance was subject to tax. The entire amount would not be subject to TOSI. And the child, if the child earns dividend income, that won't be subject to the TOSI rules if the father or no other family member is involved. Again, remember, to be a related business, you have to have someone related to you active in the business. If the father does own some shares, then the son would be a specified individual because the father is a source person. And so the son has to fall, or the daughter has to fall within an exception. So if the child is active for more than 20 hours, then it's an excluded business. And remember, the child can be 18 or older to fall within that. If they're not 20 hours a week, then it's got to be an excluded business, but the child has to be 25 to get that exception, and it can't be a service business or a professional corp. And if you fail that one, the child still has to be 25 years of age, and it has to be a reasonable return based on the factors that David talked about. And lastly, I just wanted to make the point where I go back to these slides. The child still has the ability to transfer the Opco shares to Holdco for debt. Back in the July changes, one of the things that Finance proposed effective immediately was to change Section 84.1, which would have prevented this and would have treated the child as receiving a dividend on the transfer. Now it's still possible to do that if you want to allow the child to access corporate money to pay off father or mother. So this slide illustrates some of the exceptions Dave talked about on inheritance. And here we've got father who owns 50% of Opco. He has a family trust that owns the other 50%, and father passes away, and all the shares go to a child who happens to be 18. Probably not that realistic an example, because most people don't like their kids getting the shares at 18, but we'll just work through the example so you see how it works. And I've assumed here that father's been active in the business for 5 or more years. The first exception is the one that Dave talked about, where dividends paid on the shares or capital gains are excluded if the child isn't 25 in the year. So this is an odd one because it only applies for the period when the child is 18 to 24. Once they turn 25, or if they turn 24 in the previous year, this exception doesn't apply. So if the child gets this inheritance, they're not 25 in the year, and they get it as a consequence of the death of the parent, then you don't have to worry about TOSI on dividends or capital gains. But it has to be a death of a parent, or it could be on the death of someone else if the child is in full-time attendance at a post-secondary school. I'm not sure why that exception's in there, but for example, a grandparent or an uncle could pass away and leave the child shares. The key here is as a consequence of the death of the parent. So if in the slide here, father leaves the shares directly to the child in the will, that should be as a consequence of death. But if the trust just distributes out the shares to child 18 when the father dies, it's not clear whether that's as a consequence of the death of the father. The language here is quite similar to the bump rules that we use for post-mortem planning, where you can only get a bump often where the shares are acquired as a consequence of death. And there has been CRA commentary and tax advisor commentary that suggests that if you draft the trust in the right way, so that you say, upon the death of father, trust distributes the shares to child, that might be as a consequence of the death of the father, and maybe you could boot yourself into that exception. So it's something to think about when you're drafting your trusts. The other deeming rule that could apply, and this applies regardless of your age, you can be 18, you can be 35. If you acquire shares from another person as a consequence of the death of the person, then you're assumed to get the same contribution attributes as the deceased. So if father has contributed for 5 years, then you're considered to have met that 5-year full-time test. And it doesn't matter what age you are. If, on the other hand, say father didn't contribute full-time to 5 years, but he worked 10 hours a week every week, and then in that case, it's not an excluded business, and so you have to say, can the person that inherited the shares rely on the reasonable return criteria and at least justify that a chunk of the dividends would be tax-free? Dave?
So one thing about inheritance, again, you got to go back to basics, because once the specified individual owns shares in, say, the company inherited from a parent, you then have to say, is there a source individual? So if a parent dies and leaves the shares to the child and there's no other shareholders in the company, then you're not going to even get into these rules because there's no source individual. But if a parent leaves the shares, I guess, to 2 children, then they're each going to be source individuals of the other, and you get into just a normal test.
Yeah, that's a good point. So here you have to assume that there's a sibling of child 18 that also owns shares, so it's a related business. So in that case, the child who's 18 can, as I say, inherit the excluded business exception if the father did work full-time for 5 years. If the father didn't meet this test, the child could try to get the reasonable return. And remember, reasonable return only applies to people who are 25 years of age or older. And for this purpose, the child is deemed to be 25, so they can use that reasonable return criteria. And again, these exceptions only apply as a consequence of the death of the person. It doesn't have to be a parent, but again, it has to come from a will, or maybe if you've drafted the trust correctly, that will work. This is an example that brings out a point Dave mentioned earlier about what does it mean to be actively engaged in the business. And this example is taken from CRA's guidance. When Finance released the legislation, CRA and Finance collaborated to an unprecedented extent, and CRA released a series of examples and guidance as to how they were actually going to interpret this draft legislation. And I think that comes directly from all the complaints that were raised when the July legislation was first released, because we all said, how the heck is CRA going to interpret this? It's so difficult to understand. And so obviously they were stung by that criticism, and they collaborated. And this example is basically derived from CRA's example, where you've got a couple young kids who are married. They're going to school, taking an engineering degree, and they're entrepreneurs, and they invented this app, put it in a company, and it's generating good income. There's no other employees in the business, and the business doesn't require 20 hours a week to run it. They're each putting in maybe 5 or 10 hours a week, doing different things, maintaining the app. Maybe the other spouse is dealing with the administration of the business, but they don't meet the 20-hour per week test. So in this example, you say, well, if they get dividends, how is it going to be treated? Well, even though they're providing services to the business, they can't rely on the reasonable return test, because you remember Dave said, you got to be 25. We don't know why 25. I guess Finance decided that there are no entrepreneurs who are under 25. So they can't meet that test. So then you have to say, is it an excluded business? And remember, there's that bright line deeming test that if you work 20 hours a week, bright line, you are active in the business. So here, CRA has acknowledged that in these circumstances, working only 10 hours a week will be considered full-time active conduct, given the nature of the business, given that there's no other employees required, and so that the dividends received by the young entrepreneurs will not be subject to TOSI. So it's probably not an easy test to meet, but you can imagine other situations where I suppose this might be the case. Going from one age extreme to another, we're looking at shareholders who are aging and bringing out some of the examples dealing with spouses and people passing away. Here we have another example taken from Finance, or actually CRA guidance, and it brings out another interesting point, which I'll make in a second. So here we have Investment Co. Now, Investment Co. carried on an active business for over 20 years, and it was wound down a few years ago. And now Investment Co., all it does is earns income from publicly traded investments. Sibling A was active in the business for more than 5 years, and that would have been, 10, 15 years ago. Sibling A was active in the business when the active business was running and before it was wound down. And Sibling B had a free ride, was never active in the business. They're both married. Sibling A is married to spouse A. Sibling B married to spouse B. Sibling B has died, and the common shares went to spouse B. And neither of the spouses are active in the business. So what we have now is we have spouse A has, actually, I've got this flipped around. It should be sibling A should have 50% of the common shares. Spouse A has discretionary dividend preferred shares. Because I want to make the point in a minute, if spouse A, who's not active, gets dividends on those discretionary shares, and we have spouse B with common shares. So let's look what happens to sibling A. If sibling A has common shares, he's not going to have a problem because it was an excluded business, because in 5 previous years he was active in the business when it was carried on. And on your charts, let's pretend that that says spouse A has discretionary dividend preference shares. In that case, the discretionary shares, the spouse can't, it's not going to be an excluded business to the spouse because she was never active. So then you say, are they excluded shares? And to be excluded, they have to have 10% votes in value. Well, if the discretionary shares were bought for a nominal amount, even if they've been getting big dividends, they probably, and even if they have 10% of the votes, they probably don't have 10% of the value. So you probably are not going to get an excluded share exception for spouse A, and those dividends will be subject to TOSI. Now what happens, though, if the sibling A turns 65? Well, in that case, the rule that Dave mentioned, spouse A's dividends on the discretionary shares will be okay because of the exception that if spouse A had received it, it would have been accepted from TOSI, because in spouse A's case, it was an excluded business. So you can start to income split with spouse A once once her spouse turns 65. And if sibling A dies and leaves the common shares to the spouse, then the spouse will be able to receive dividends because of the inheritance exception we talked about before. Now, in the case of spouse B, that's an interesting one. This is where, remember, sibling B was not active in the business, died, left the shares to spouse B. So the question is, are the spouse B shares excluded shares? They can't be an excluded business because sibling B was never active. Are they excluded shares for spouse B? Well, they're more than 10% votes in value, so that's true. But remember when we talked about excluded shares, that there's that third exception? And the third exception says that if the income generated in the investment income is derived directly or indirectly from an active business, then you fall outside excluded business exception. And remember that the money that Investment Co. is investing was generated from that active business that was carried on for 20 years. You could argue that there's a nexus there, because even though that active business hasn't been run for a long time, that created the retained earnings and investment capital for Investment Co. now to generate and pay dividends. But in the CRA example, CRA says, just without a lot of analysis, they say dividends to spouse B is not split income because she owns excluded shares. So it's that example perhaps suggests that CRA will interpret that rule as requiring a closer nexus. So where there's some period of time that's gone by where the active business is no longer running, and now the company turns into an investment company, maybe then after a few years, those dividends are okay. But I don't know if that means you have to wait 3 or 4 years. The example just says many years, that the business was wound down many years ago. It didn't say 3 years, 5 years, 10 years. So that's an interpretive question we're all going to have to deal with.
Yeah, I'm just going to deal with one of the questions. So this before the year wording is confusing some people. So basically, if you're in the current taxation year and you want to be outside the rules, if you were 24 in the previous year, so if we're in 2018, getting caught by the rules, If you were 24 in 2017, you're fine, you're 25. And similarly, the 65 test, if the spouse is 64 in 2017, you'll be fine in 2018.
So, two more examples, and then we'll try and deal with a few more questions. I've just called this sidecar structures, and the results I'm focusing, as Dave mentioned, on corporations, but I think you get the same result here is if spouse B that owns a real estate company and a management company, if those were partnerships or trusts that spouse B was a partner of or a beneficiary of, you'd probably have the same result here. So in these facts, you've got spouse B that owns a real estate company that leases real estate to Opco. Opco is owned by spouse A. A and B are married. And the family trust owns Opco shares. And there's also a child of spouse A and B who owns shares in Opco. And spouse A is active in Opco's business and spent 20 hours or more in the business. Spouse B, on the other hand, only spends about 5 hours a month in the business of the real estate co. and about 5 hours a month in the business of management co. So management co. also has a bunch of employees, and it provides management services to Opco. Opco pays a management fee to management co. So you've got a structure then that Opco is carrying on a business. It'll pay dividends to all three of its shareholders, and the spouse owns two different companies that generate income, which is really generated from the Opco payments as either lease payments or management fee payments, and those two companies will pay a dividend up to spouse B. So let's see how TOSI might apply here. On the dividends paid by Opco, if they're paid to spouse A, just going back here, since spouse A is active in the business, it'll fall within the excluded business exception, and spouse A won't be subject to TOSI. If we look at dividends paid to the child, they can't be excluded shares, even though the child might have shares worth 10% votes or value, unless the child is 25 or older. They can't be a reasonable return if the child is under 25. So even if the child is doing stuff in the business, the reasonable return test doesn't help if they're under 25. But if the child works 20 hours or more in the week, then it could be an excluded business, and the child could get dividends, and that doesn't matter what age the child is. The child could be 18 or 30. If they're working 30 hours or more in the business, it's okay. And the same deal with dividends paid to the trust. If they're distributed out to the children will be subject to TOSI unless they're active full-time in the business. The excluded share will not protect them because they don't own the shares directly. So that's the Opco side. On the real estate company, if it pays dividends to the spouse, who's married to spouse A, it'll be split income because the rental income is derived directly or indirectly from the business of Opco. And there's a special supporting rule that makes that really clear that says that income of the realty company that's generated from the provision of property to Opco is considered to be derived from Opco's business. So here, because Realty Co. owns real estate, it provides that property through the lease to Opco for the use in its business. That means the real estate rental income that's received by Realty Co. is going to be viewed as coming from the business, and therefore it'll be split income. Then you have to say, well, is there an exception that the spouse can rely on to get out of the split income rules? And the first one you'd think about is, well, is it an excluded share? Because the spouse B owns all the shares of Real Estate Co., owns all the shares of Management Co. Well, remember, to be an excluded share, you have to have more than 10% votes in value, but there's that Part C part where it can't be derived from income of the business of Opco. And so because of this amplified deeming rule, you're not going to be able to get out as an excluded share, and the only thing the spouse can justify then is a reasonable return. So if she's spending 5 hours a week in the business, you have to decide what's a reasonable return. And it's interesting here is, how do you figure that out? Because you're supposed to measure it by reference to the contribution that the founders made, or the spouse A that's running Opco. Here the businesses are very different, so I don't know really how you can figure out what's spouse B's contribution in relation to running the real estate company, and you compare that to what spouse A is doing in relation to running the business of the operating company, which are two totally different things. But that's what we're going to be faced with, is trying to justify what a reasonable return is. Now remember, spouse B also got dividends on the management company, and it's the same idea here, where it's split income because of the connection and the amplifying rule in the third bullet there that says that income of a management company from the provision of services to Opco is considered to be derived from Opco. So they've got a special rule dealing with the provision of property or the provision of services. And here there's two reasons why it's not an excluded share of the spouse. One is because most of the income is from services, and services businesses don't get the exclusion. And the second reason is because of the connection with the income of Opco. So you're back to the same result. You have to justify the dividends paid to the spouse B on the basis of what is her 5 hours a week, or his 5 hours a week, worth reasonably. And again, you've got those interpretive issues. And the last example, I think this is the last example, yeah, brings out just a couple points about the service business and professional companies. So here, spouse A and B are married. They've got each shares 50-20 in professional co. And spouse B has shares in a painting company that her sister also has 50 shares in. And spouse A is active in the professional company business. Spouse B is not active in either the professional company business or the paint company business. Instead, spouse B's sister is the one who's active in the paint company business. And the paint company has a staff of 50 employees and independent contractors, and it paints houses. So let's figure out what happens on dividends paid by the professional company to spouse A. Well, I guess that one's simple. It's an excluded business. So now if we pay dividends to spouse B, it can't be an excluded business because she's not contributing, she's not active. So could it be an excluded share of spouse B? And here we get denied the excluded shared exception, because if the professional company carries on one of the enumerated professional practices, you're not going to fall within the excluded share exception. So the only out for spouse B will be when her spouse turns 65. And there can be a big gauge gap, right? The spouse who's active in the business could be 20, 30, 40 years older than the younger spouse. As long as the older spouse turns 65, then you can income split with the other spouse, and you don't have to worry about these prohibitions. What about the paint company? Well, it'll be a related business to spouse B because her sister owns shares. And remember, if the related person owns 10% or more of the shares, it doesn't even matter if the sister is active in the business. That's enough nexus. In this case, sister happens to be active. And then you say, well, is the paint company shares excluded to spouse B? Well, remember, we meet the 10% votes and value test because Spouse B has 50% of PaintCo's shares. But one of the requirements is you can't have 90% or more of the income from provision of services. So then you're into, well, what does a painting company do? If I hire somebody to paint my house, I guess they're providing the service of painting a house. What happens to the paint that I buy? Is that considered part of the service? So when the company is recording sales, does it try to break out the profit or the income associated with the paint sales from the service sales, or are they so closely tied, would it all be considered service income? So if paint sales represent 10% or more of the total income, is that a way of getting it out? So again, I'm not sure why service businesses in this example shouldn't have the same exception for excluded shares, but they don't. And where you've got a mix, maybe it is worthwhile, if the numbers merit it, to break out your company into a couple different, or your two divisions into a couple different companies to try and fall within this. And again, remember, we're just talking about the tax savings on that marginal rate, and so some of these reorgs won't be worth it if you're only talking about income splitting with one person, and you may just want to take an interpretation that benefits you and sort of facts that maybe are similar to this. So that wraps up my example.
Yeah, so before we have just a few questions we can answer. Just in case you drop out now, there's going to be a follow-up email that we sent out at the end of the week, and we'll include a copy of today's presentation, the audio recording. And before we get to the questions, I want to thank you all for tuning into our webinar. We have over about 1,000 people who are registered, so thank you very much for that. And as you can imagine, with 1,000 people registered, we have too many questions to answer, but I'm going to deal with some of them in the remaining 5 or so minutes. So one of the questions isn't really based on today's presentation, but is talking about the effective date of the new tax on investment income and when will that be applicable. They have said that they're going to be tabling that with the budget. We don't know when it's going to be applicable. I wrote an article that was circulated on the grandfathering with respect to that, and I'm concerned on whether they're going to be grandfathering your investments or your retained earnings. If you want a copy of that article, you can just shoot me an email. But I guess we'll turn our attention to that now that we've digested these income splitting rules. One of the questions was, if the founder retires and then 4 years after retirement they sell their non-QSBC shares, will the capital gain be TOSI? Once somebody retires, you're going to want to ask the following questions. And this is where there'd be other shareholders in the business, so maybe the kids took over. Did that person work in any 5 years, meeting the 20%, 20 hours per week test? Did they work for 5 years in a significant way? And you can't really prove that for the past, but I think that if it's a successful business, that the CRA will probably look at it and in previous years probably accept your evidence on what the commitment was. If they didn't work those 5 years, the question is whether their return is reasonable considering what they did for the business. And there's also going to be the question of whether it's an excluded share. One of the questions was on the actively engaged, do we take into account vacations and statutory holidays? It's a good question. I think what you want to do on the deeming provision is make sure you work at least 1,040 hours in the year. And I think then you'll be okay. There's no mention of vacations or statutory holidays in the provisions. One of the questions is, one thing we've been touching on is an investment holding company, a business. I guess, first of all, if those funds came from an active business, you're probably caught. If not, we're hoping we get some clarification when the rules are finalized, either from finance or from the Canada Revenue Agency. Our thought now, if it's not really an active business and the funds did not come from an active business, probably that investment company is not going to be subject to TOSI, but we'll wait to see what comes out from the Department of Finance or the CRA. One question is, how about cousins? Are cousins caught? So cousins are not caught because they're not related. And then one question was, is service business a defined term? They don't actually call it a service business. They say less than 90% of your income has to be from something other than the provision of services. And if you think about it, a painter, a plumber, an electrician, a lawyer, an accountant, we're all providing services. So the real question isn't, is service defined? It goes back to, what is a business, and can you have a corporation carrying on something that isn't a business? And so that's really going to be the more important test, I think. The 5-year test is any 5 years. It's not consecutive. So it could be you worked, significantly in, 2014, 15, 17, and whatever. So it doesn't have to be consecutive. Stuart, do you have any more that you can answer there?
I don't know if you mentioned this, Dave, but a few questions came up whether people have to actually be paid.
No.
And I don't think so. I think you measure your contribution in terms of the value under the different indicia. I guess what you get paid is arguably some demonstration of that, but in a closely held company, we all know that the kind of compensation you get is a mix, and there may be deferral that you just plan for because the founder doesn't require the money. So I think it's really a determination of the contribution, not what the source person's being paid.
Yeah, another good question is a typical estate freeze going to be gone now? So I think, most of our reorganization work involving estate freezes is where we want to try to determine the amount of tax that's going to be paid by the founder and his or her spouse on death, and we're trying to freeze that value. So if the business increases incredibly in value, then the tax on death doesn't take into account that increase in value. And that's almost always the driving reason why you're doing an estate freeze. The income splitting is usually an added benefit. That you get the founder gets some payback right away because they can income split. So we don't see estate freezes being negatively impacted by these rules. The problem is you may be doing an estate freeze and not being able to income split. One other question was, does the age 64 rule apply to all businesses, including professional corps? It does. So if you're 65, you're okay. But if you're a lawyer and you have a professional corporation, and the lawyer's 65, he can't income split with his or her spouse because he or she can't be a shareholder in a lawyer's professional corp, unless they are also a lawyer. For doctors, it'd be fine because doctor spouses can be shareholders. So maybe we'll do some lobbying and get the government to change those rules.
One of the questions, if Dave, you haven't touched on it, excluded shares, do they require votes in value on the same shares, or can they be split among classes? And the answer is they have to be the same class of shares. So that another example said, what if you did a freeze and you had 2 million of preferred shares and the trust owns some growth? Could you distribute some growth shares to the beneficiary so that if the growth and the freeze together amounted to more than 10%, would you be okay? No, it's got to be one class of shares. But if the growth shares themselves were more than 10% votes in value and you distributed them to the beneficiary, then you could be excluded. And one other question where I may have confused people, the 5-year rule to get the capital gain, where we talked about to be an excluded business and avoid capital gains being subject to TOSI, you had to carry on the business for 5 years. That's just for the excluded business exception. But if the shares happen to be qualifying for the capital gain exemption, you don't need to have that 5-year contribution test. They just qualify under a separate exception.
Anyway, thank you for attending our webinar, and enjoy the snowy day, unless you're listening from Barbados or Jamaica. And if you are, you should be enjoying your holiday and not listening to our webinar. Take care.